Question number 1. A publicly held company issues financial statements that purport to present its financial position and results of operations, but omits the statement of cash flows. What report modification is appropriate? Letter A. An adverse opinion, since the omission is a pervasive departure from GAAP. Letter B. A qualified opinion, since the omission is a departure from GAAP. Letter C. A disclaimer of opinion, since the auditor cannot verify cash flow information. Letter D. An unmodified opinion with an emphasis of matter paragraph noting the omission. Correct answer is letter B. Explanation. Letter B is correct because omitting the statement of cash flows, when the financial statements otherwise purport to show financial position and results of operations, is a departure from GAAP, and that specific kind of departure calls for a qualified opinion rather than something more severe like an adverse opinion or a disclaimer. Question number 2. In which of the following situations would an auditor ordinarily choose between expressing a qualified opinion or an adverse opinion? Letter A. The auditor was unable to observe the physical inventory count and could not become satisfied about the balance through other procedures. Letter B. Required disclosures have been omitted from the financial statements, a departure from GAAP.
Okay.
Letter C. The entity has changed an accounting principle during the year. Letter D. The auditor was unable to apply certain necessary audit procedures. Correct answer is letter B. Explanation. Letter B is correct because omitting required disclosures is a departure from GAAP, and departures from GAAP are exactly the kind of issue that leads an auditor to choose between a qualified opinion and an adverse opinion, depending on how pervasive the omission is. Scope limitations, like being unable to observe inventory, led down a different path toward a qualified opinion or a disclaimer instead. Question number 3. An auditor did not observe the client's beginning physical inventory count and was unable to become satisfied about its accuracy through other procedures. What opinions should be issued on the balance sheet and the income statement? Letter A. A disclaimer of opinion on both the balance sheet and the income statement. Letter B. An unmodified opinion on the balance sheet, and a disclaimer of opinion on the income statement. Letter C. An unmodified opinion on the balance sheet, and a qualified opinion on the income statement. Letter D. A disclaimer of opinion on the balance sheet only, with an unmodified opinion on the income statement. Correct answer is letter B. Explanation. Letter B is correct because the missing evidence about the beginning inventory does not affect the year-end balance sheet, so an unmodified opinion is possible there. But without knowing the beginning inventory, the auditor cannot verify cost of goods sold, which is an income statement figure, so a disclaimer is needed on the income statement instead. Question number 4. Which of the following circumstances would most likely result in an auditor expressing an adverse opinion? Letter A. The client refuses to provide the auditor access to board meeting minutes. Letter B. Internal controls over a significant transaction cycle are weak. Letter C. The entity inappropriately accounts for its leases, a departure from GAAP. Letter D. Substantial doubt exists about the entity's ability to continue as a going concern. Correct answer is letter C. Explanation. Letter C is correct because inappropriately accounting for leases is a genuine departure from GAAP, and severe departures from GAAP are exactly what leads to an adverse opinion. Scope limitations, like being denied access to board minutes, point toward a disclaimer instead, and going concern doubt leads to an entirely different kind of report. Question number 5. In which of the following circumstances would an auditor most likely not express an unmodified opinion? Letter A. A material change between periods in accounting principles has occurred. Letter B. Required unaudited quarterly financial data has been omitted. Letter C. The auditor wishes to emphasize an unusually important subsequent event. Letter D. The auditor was unable to obtain the audited financial statements of a consolidated investee. Correct answer is letter D. Explanation. Letter D is correct because being unable to obtain the audited financial statements of a consolidated investee is a scope limitation, and the significant scope limitation is exactly what prevents an unmodified opinion. The other situations, such as a change in accounting principle or emphasizing a subsequent event, are all handled with an unmodified opinion plus an added emphasis of matter paragraph, not a true modification. Question number 6. When an auditor's report reflects a scope limitation, which parts of the report should refer to that limitation? Letter A, only the notes to the financial statements. Letter B, only the opinion paragraph. Letter C, both the auditor's responsibility paragraph and the opinion paragraph. Letter D, only the auditor's responsibility paragraph. Correct answer is letter C. Explanation. Letter C is correct because when there's a scope limitation, the standard approach modifies both the auditor's responsibility paragraph, which describes the limitation, and the opinion paragraph, which reflects its effect on the opinion. It is never appropriate to explain a scope limitation only in a note to the financial statements, since that's the auditor's own reporting responsibility, not management's. Question number 7. In which of the following circumstances would an auditor choose between issuing an except for qualified opinion and an adverse opinion? Letter A. The auditor was unable to observe the client's physical inventory count. Letter B. Required financial statement disclosures have been omitted, a departure from GAAP. Letter C. The auditor is asked to report on only one financial statement rather than a full set. Letter D. Substantial doubt exists about the entity's ability to continue as a going concern. Correct answer is letter B. Explanation. Letter B is correct because omitted required disclosures represent a departure from GAAP, and that is precisely the kind of issue where the auditor weighs whether to issue an except for qualified opinion or, if the omission is severe enough, an adverse opinion. A physical inventory scope limitation leads down a different path entirely, toward a qualified opinion or a disclaimer instead. Question number 8. An auditor disclaims an opinion on an entity's overall financial statements. Would it be appropriate for the same report to also include a statement that the current asset portion of the balance sheet was fairly stated? Letter A, no, because such a piecemeal opinion would tend to overshadow or contradict the disclaimer. Letter B, yes, because an auditor may always report separately on individual financial statement items. Letter C, yes, but only with negative assurance rather than a full opinion. Letter D, yes, provided the current assets are separately audited from the rest of the balance sheet. Correct answer is letter A. Explanation. Letter A is correct because once an auditor has disclaimed an opinion on the overall financial statements, adding a separate statement that one piece, like current assets, was fairly stated would create what's called a piecemeal opinion. That kind of add-on tends to overshadow or contradict the disclaimer, which is exactly why it isn't allowed. Question number 9. When an auditor qualifies an opinion because of inadequate disclosure, which paragraphs of the audit report are modified, in addition to the inclusion of a separate basis for qualified opinion paragraph? Letter A. The introductory paragraph and the auditor's responsibility paragraph. Letter B. Only the auditor's responsibility paragraph. Letter C. The introductory paragraph only. Letter D. Only the opinion paragraph. Correct answer is letter D. Explanation. Letter D is correct because when an opinion is qualified for inadequate disclosure, the only paragraph that gets modified, beyond adding the new basis for qualified opinion paragraph, is the opinion paragraph itself. The introductory and auditor's responsibility paragraphs stay as they are. Question number 10. An auditor was unable to obtain sufficient appropriate evidence about the consistent application of accounting principles between the current and prior year. What type of opinion should be issued? Letter A. A qualified opinion or disclaimer covering the income statement and cash flow statement, since the scope limitation affects the current year's results of operations and cash flows. Letter B. A qualified opinion covering the year-end balance sheet, since beginning balances are always presumed correct. Letter C. Withdrawal from the engagement, since consistency cannot be verified. Letter D. An unmodified opinion with an emphasis of matter paragraph describing the uncertainty. Correct answer is letter A. Explanation. Letter A is correct because not being able to verify consistent application of accounting principles between years is a scope limitation that reaches into the beginning balances, and beginning balances feed directly into the current year's results of operations and cash flows. That is why the qualification or disclaimer applies to the income statement and cash flow statement, even though the year-end balance sheet itself is unaffected.